Hi and welcome to Homework Rants. This is Professor Elizabeth Keating, and I'm going to walk you through a problem from the Introductory Financial Accounting textbook by Horngren, Sundem, Elliott, and Philbrick, the 11th edition. That is also the same problems that would be found in the second custom edition for Boston University. In this video, we'll look at problem 326. The goals and objectives I'd like to cover. I'm going to review what are debits and credits, review how to record journal entries, talk about how to post journal entries. But one thing to note about this particular homework problem is there's only partial information, so there won't be any opening balances included on the balance sheet accounts. So now we're going to talk about the balance sheet equation and how to create a system of debits and credits to always keep this equation in balance. The balance sheet equation is assets equals liabilities plus equity. In other words, the things we have of value are paid for either by other people's money or by resources provided by investors. Now we're going to start with just one arbitrary assumption, which is that we're going to give the name debit to an increase on the left-hand side, which is an increase to an asset. And based on that one decision, the whole rest of the debit and credit structure will come in place. So if we call an increase in an asset a debit, then the opposite activity, a decrease in an asset, needs to be given a name, and we're going to call that a credit. So anytime we're going to talk about an asset increase, we're going to write it on the left-hand side of a T account, and anytime we're going to talk about a decrease in an asset, we're going to write it on the right-hand side, on the credit side. So one way of keeping the balance sheet equation in balance is to have assets go up as a debit and assets go down as a credit. A different possibility is that if assets go up, either liabilities go up or equity goes up. And so therefore an increase in a liability or an increase in an equity can also be used to offset an increase in an asset. And since we gave the name credit to a decrease in an asset, we're going to similarly call an increase to a liability or an equity a credit. So we're calling liability and equity increases credit, and therefore decreases and liabilities and equity must be called the opposite thing, or debits. So we now have a system here that covers all of the balance sheet accounts, and we can create a change in the balance sheet equation by instituting a debit and an equal amount of credits, and we can mix and match between these three different categories. So having looked at the balance sheet accounts, let's move on to the income statement. What we do when we do accounting is that we temporarily record certain types of changes in one balance sheet account, the retained earnings account. We temporarily record certain types of activity as either a revenue or an expense in order that we can prepare an income statement. So it turns out when we record a revenue, we're increasing retained earnings, which is an equity account. So we've already decided that when equity goes up, we're going to call it a credit. And therefore, when we book a revenue, which will ultimately flow into equity, when we book that, we're also going to call it a credit. Now, when we record an expense, it decreases retained earnings, and retained earnings is a kind of equity. So therefore, when we book an expense, it's a debit, just like when we decrease equity, it's a debit. So now I want to take a minute and talk about a particular account, which is cash. So under the system that I've just outlined, when an asset goes up, it's a debit. So when we receive cash, we are debiting cash. But wait a minute. I think we all know if we talk to a banker and a banker says, I'm going to credit your account, you're going to have more cash in the bank. How can that be? So I like to use this graphic of a dog looking at himself in the mirror. And you can see it's two opposite images that are being depicted. But when the banker says to you, I am going to credit your account, the banker's talking about what the banker is planning to do. He is planning on his books to record a credit, and his bank balance will drop. What's happening on your books is the opposite. You are receiving cash, and so your cash is being debited. So now let's talk about the opposite situation in which you are paying out cash. So if you receive cash, you're receiving a debit. And if you're paying out cash, then you're recording a credit. So we've now looked at all the possible combinations of debits and credits, and here is the summary graphic. So now let's move on and look at problem 3-26. In the problem, the first requirement, A, has the firm purchasing supplies inventory of $900,000 on credit, meaning it's going to pay later. So what we can see here as a layout is a journal entry. The top line is the debit. It is written further to the left. The second line is the credit. It's indented to the right. And then we can see the headings debit and credit. So supplies inventory has a debit of $900. Let's go over to the chart. If an asset goes up, it's a debit. That's right. We bought supplies inventory. It went up. And now let's look at the credit. Accounts payable. That's a liability. We go over, yes, a liability went up. Yes, we owe more now, $900 more to suppliers than we did before. And now what's written on the very bottom line there is acquired office supplies, which is the description. Let's post that first transaction into T accounts. We can see depicted below two T accounts, supplies inventory and accounts payable. The asset, the supplies inventory, has received a debit of $900, and the liability, accounts payable, has received a credit of $900. Moving on to journal entry B. The firm has now sold some real estate. It receives cash of $9,000, and it recognizes commission revenue, a type of service revenue, of $9,000. So you can see cash is being debited because it's an asset, and we can see revenue being credited. As you can see in the graphic, that's what should happen when we recognize a revenue. And now we'll go about posting this transaction. We see the cash T account receiving the debit of $9,000, and we see a brand new T account for commissions revenue receiving a credit of $9,000. Now we have journal entry C. The firm has paid $750 for newspaper ads. So cash has left the firm. So, right, that's a credit. The asset's gone down. And now we've recorded that as a current period expense of advertising revenue, and expenses should be debited. We'll now post the cash there, a reduction as a credit of $750 in the T account, and the advertising expense will create its own new T account, and as an expense, that should be recorded there as a debit. So now on to requirement D. The firm is going to pay $500 to pay off part of what it owes for the office supplies. So the cash, the asset, will drop, so that should be a credit of $500. And the liability we recorded, the account payable, will also decrease. And when a liability decreases, that's a debit. We'll now post requirement D, and we can see we've added a second credit to cash of $500, and we now look at the account payable account, and we'll now have a debit sitting there of $500. So let's look where we are right now on accounts payable. We originated an account payable of $900, and we've partially liquidated it or reversed it with $500. So if we wanted to know the present balance in accounts payable, we'd take $900 and subtract the 500, and we would say we have a current balance of $400. And now on to requirement E. The way we've been accounting for supplies is that we put all of the supplies we purchased, we stored it on the balance sheet as an asset, saying that those supplies will benefit us in the future. And what happens when you use this method of accounting for supplies is at the end of a period, you need to go in and count the inventory and see where you are. So at this point in time, they go out and count, and they see that what they have remaining in inventory is $600. And so in order to have just $600 sitting in inventory on the balance sheet, they have to remove $300. So to remove $300 from the balance sheet, reduce that asset, we have to record a credit to despised inventory, and hence we will say we have used up, we've consumed $300 worth of supplies, so that should be an expense on the income statement and hence a debit. Okay, so now to bring this particular problem to a close, we're going to post the supplies we used into the T accounts. So the supplies inventory is going to decline by 300 by crediting supplies inventory. So having 900, subtracting 300 will leave us net with 600. And then we'll look at what's going on in the income statement, which is we've created a new T account, the supplies expense T account, and we have stored $300 in that account as a debit. And so that concludes our look at problem 3-26.